Good morning. My name is David Safir, and welcome to today's Cash Flow Clinic. And the topic is loans, credit lines, and the truth about government emergency loans. And today, instead of trying to give details on how to apply for a loan, how to apply for the government emergency loans, what the rules are, there's a lot of people who will talk about that. And we might have a guest on in a little while, if he can make it, that will help explain a couple of those things. But today, what I want to focus in on is, what do you do once you get the money? Now, I'm talking about whether it's a government emergency loan, what's called a PPP, which is a payroll protection loan, whether it's a grant that you're going to get in, even if you get what's called free money. If you don't use it properly, you will still go out of business. So let's talk about this a little bit, about what you're going to do when you get the money in and how to make sure you manage it properly for the most effective use. So the first thing I'll talk about is, when you're working with a government loan, a government, what could become a grant, they're going to want to get documentation to make sure that you spent the money on what you said you're going to spend it for. Now, with this PPP loan that can be forgiven, you will need to keep track of especially your payroll expenses. If I understand correctly, you need 75% of the money to be used towards payroll. And then there's ancillary things like rent, mortgage, which could be rent, I'm not sure. I'm not an expert on this stuff, but what I can tell you is tracking will be important. So in my mind, the best advice I've heard for tracking this money is, in addition to putting it into your bookkeeping software, is to set up a separate bank account and draw upon those funds only for the things that qualify you for the grant. Now, unless, in my mind, there's an unless you need it for other things, and then you got to check in to make sure that you're allowed to. I know you're going to have to pay it back under that case, and I think it's fairly favorable interest rates, but tracking will be really important to do. Okay, so that's number one. Number two that I want to talk to you about today is, when you borrow money, no matter what the source, or you have a credit line. And a credit line is money that could be borrowed at some point if you need it. You are going to want to not just spend the money, you're going to want to use it wisely. And what's the difference in my mind between the two? Spending money is something that you don't need. If you decide that you're going to constantly be going out to lunch on this money, you don't need to. If you decide you're going to, for no good reason, you've got a work truck that you want to upgrade to a newer model, even though the current truck is working just fine, that's more spending money than using it. If you don't get any better utility out of it, it's different if you need to go from a half-ton to a full-ton or a 2-ton truck. Completely different issue. All we're talking about is the shiny objects here. That is money that goes in one direction, which is out the door. And what you're looking to do is use the money wisely, that it returns an investment back to you over time. A good example would be, if you need a new truck because you have a need for either additional capacity with a second vehicle, or you need an additional capacity as far as the workload, that's an investment, because that would mean you probably have a contract that needs to be fulfilled that requires the additional capacity. Those are the things you're looking for. But let me ask you a question. And I just had a phone call with somebody yesterday who said, you know what, we invested in something that we needed for this job, and I thought we could afford it, but a month down the road, it put us in a real world of hurt. So how do you prevent that from happening? The answer is put together a cash flow model. You want to know, even before you get money in the door, where your cash is going and how it's being spent, so that you can use it wisely and extend the life of your business. If you're in an emergency situation, I'm recording this during the COVID-19 crisis, but an emergency situation could be that you lost a large customer and all of a sudden a big source of revenue dried up, or you have a hurricane or some other short-term natural disaster that's regionalized. It could be any one of a number of things where all of a sudden you go, oh my gosh, how am I going to make payroll? How am I going to do one of the million things that has to be done? How am I going to afford it? The answer is you project it out, you plan it, and so you know between today, which is Friday, and Monday, what you think your expected bank balance is going to be on Monday. But not just 1 week, but how about 2 weeks out, 3 weeks out, 4 weeks out? The fundamental timing on this is a weekly projection for 13 weeks in the future. When I say fundamental, that's what people who are experts at managing cash do, especially within a small business environment. That's what I do, but I also work with the firm New Point Advisors Corporation, that's what they do. And we didn't know each other just a little while ago, but yet do the same thing. And why do they do it? Because they work, and now we work with banks with special assets, and special assets are problem commercial loans. And what is the first thing that they're trying to do is figure out what the cash flow looks like in the future. What money's coming in, what's the spending plan going out, and what is the bank balance going to be at the end of that time. Now, I noticed that a couple of people have logged in. If you have questions, let me know. What we're talking about today is about how to use the funds and how to track them if and when you get a loan. So here's the other thing that I recommend. We talked about two types of loan. One is just an all-out loan, and the other one is just opening up my Q&A box in case you have questions. I'll see them come up. So the difference is, one is a line of credit. It's a resource. If you need it, you take it, then you pay the interest while you're using that money. If you put it all back, there's no interest. In a loan, you receive all the money up front and you have to start making payments month to month immediately. You're always paying on the interest. So I want to talk to you about how to treat those from a planning perspective. This is my suggestion. It is not a rule. I suggest with a line of credit in your business model, your cash flow modeling, that what you are doing is paying back most or all of your excess cash into the credit line. So let's say you have $100,000 in cash that you have in your bank account, but owe $25,000 to your credit line. And David Sherwood just joined us from Lendbase. David, do you want to say something so we can make sure your sound is working? I'm not hearing you so far. I'll let you know as soon as I can hear you. And it might be that my sound is turned down too low, but I don't think so. Nope, my sound is turned on. All right, so what I was talking about is, if you got $100,000 cash, $25,000 balance that's owed on your credit line, pay off your credit line. You have $75,000 left, but your credit line now has an additional $25,000 left if you need it. Well, I'd like to make a suggestion for a bank loan. We've already talked about for the PPP having a separate bank account, but let's talk about another loan that's not going to be turned into a grant. Once again, an idea is open up a bank account. It could be a savings account. You'll learn a minuscule amount of interest, or maybe you'll reduce some fees, but use the money as you need it. You're going to have to pay it off. But as you have excess cash in your bank, your checking account, move it into this other bank account, which has your loan money. So you can keep track of how much that loan money you've used, and you don't mix it into the general fund. And why would you want to do this? Number one, we talked about, instead of spending money, you use money. So you use the money, invest it as you're getting your cash back in, put it back so you can use it again. And number two is, at some point you might realize you no longer need the cash that you borrowed. And then you have this chunk of money that you can pay it back a large amount all at once. It might be only 10% of the loan amount, but that still helps you get the loan paid off sooner. Or certainly it allows you to extend that capital for a longer period of time and put it to better use. So I'm going to just take a look at my notes, see what I've missed, if I've missed anything so far. So the biggest question is, will your business survive? And for how long? And to be able to survive, you need cash. So that's why we talked about a 13-week cash flow model. That basically gears towards immediate survivability. However, if you want to take the next step, then you can start projecting cash flow out on a much longer weekly basis, or get to a monthly cash flow model out for a year or two. Because then you can really see, are you accumulating cash over a long period of time? So you know that you might have it to invest, or if you're going to have long-term capital needs that you can plan in advance. Now, let me ask a question to myself, which is, which scenario do you think a banker is more likely to lend on? Number one is the scenario where you come in and say, hey, listen, this is my P&L that I did last year and 2 years ago and 3 years ago. That's my history. Will you give me a loan? That's scenario one. Scenario number two is, here's my history, but let me show you a detailed cash flow model that will project out to you for the next 13 months, in the next year or two. And in addition to what we see as historic trends, we're going to show you what we're going to do with that money, what we see as the expected return to the business on that money, and why you are making a safe investment that will show you how we can pay you back. In other words, not only is what your business is normally doing, but you also put in there the monthly payment that you're going to have to return to the bank, so they can see that you actually know and have planned for the payment that's going to be on the loan. Now, of course, it's an estimated payment, but that's okay. Think about conceptually, which scenario will a banker more likely to be willing to bank on? Now, we're talking about commercial loans. And when I talk about a banker, let me rephrase that, because my friend David Sherwood, who joined us for a minute but had communication issues, he's not a banker. He doesn't work for a bank. He works for a lender. They do commercial lending and have relationships with a lot of different banks. So whether you're talking directly to a bank or to a lender, the scenario where you're not only asking for money based upon your historic results, but also showing a sound plan for what the money will be used for, what the business results will be projected to be, that are reasonable projections, that's going to go over much better with any lender. Now, some people will say, but David, you can't predict the future. The only thing you can predict about the future is that it's always changing. Absolutely. I agree 100% with that. But if you don't have the confidence to take a best guess or do a range, show two models, show a model that is a complete failure. If you can still pay that loan without getting improved results out of your business, that's going to send a really positive message. And then you can show another model that says, but this is what we expect as a minimum, a result of the loan we're getting and the investments we will make. Loans, credit lines, the truth about government loans. This is a huge issue, not just today during an emergency, but always. I'm available on LinkedIn. Look for David Safeer, David Safeer. I'm very easy to find. This will be posted to my YouTube channel, which again is David Safeer. And I have a series of videos going up called Cash Flow Clinic. We'll have different topics that are timely and revolve around cash flow. And it's not all the common knowledge that you can read anywhere and everywhere. We're going to be digging deeper into this topic of cash flow management over the next few weeks, over the next few months, and over the next few years. So I hope you'll join me. And I'll ask one more time. Nobody seems to have any questions, which is fine. Ask me offline if you want to. I'd be glad to answer questions. Have a wonderful day and stay home right now and stay safe. So I just stopped the recording and we're done.